Welcome back, everyone. It is Michael, as usual, with Offshore Citizen, and we're going to continue our ongoing conversation about the subject of investing through this crisis time. And I'm going to spend a bit of time just bragging for a second because previously I was mentioning that, in my opinion, Beyond Meat was a great buy. It had dropped down to like pre the IPO price, and it's up 100%. So bravo, excellent. Luckier than I deserve to be in that sense, but hey, you know what? I'll take it. Some of the other things, have not gone up massively. Restaurants, some of them are up pretty good. Cake and a few of these, like Jack in the Box, is up a bunch. But airlines are still down. Cruise ships are still, down, etc. And we'll see. Okay, minor recovery, but nothing to write home about. So we're going to see over time how those do. Shell is of course doing decently, and that was kind of a longer term thing that it was. I was really taking some insights from somebody else, so Tio, you deserve credit for that one. Anyway, we'll take it where we can get it. We wanted to talk about, okay, now that things have changed a little bit, right? What did we see? We saw a bunch of uncertainty. The market plunged. It hit this point that it bottomed around 18. I'm talking about the Dow numbers. So 18,000, went back up, had this little up down thingy going on here, depending on what assets you were looking at, and now has been kind of optimistic, I would say, all things considered. I had somebody send me some numbers on the GDP drops and kind of the forward-looking scenario here over the last just like, I don't know, an hour or so ago, and they were commenting. They're like, GDP numbers and the outlook looks so terrible. Yeah, the market is a forward discounting mechanism, but the outlook looks awful. How is it that you can justify this kind of scenario? And it's an interesting question, right? So I had previously said that I thought you wanted to be in equities, and I think we've seen that equities were broadly good. At this stage, I'm not investing, and I would say that we're talking about investing in stocks or bonds, and I would say that I wouldn't be recommending people to invest. So if you got into something like Beyond Meat, when I mentioned it at it's about $57, then it's well over 100 now. Great. If you want to hold on to it, I think that it's a fairly strong long-term company. Like I said, the market tends to undervalue or underprice very high growth, and it's a very high growth company. So in that sense, I think that it's generally optimistic to look at. That being said, if you say, hey, look, I just made 100% on my money, I took that bet, and I want to take the cash off the table and put it somewhere else, I certainly wouldn't blame you for that, because like I said, 100% growth, is it going to go another 100%? It actually could go another 100%. That's possible, although I think, well, it depends over what time period, right? It's all about the time periods. So where are we today, and what are kind of the opportunities? What's going on? Well, a bunch of these are still down, right? We're still seeing, like I said, airlines are down, cruise lines are down, restaurants, a bunch of them are not down as much. You've got, you could look across, a bunch of stuff is up, right? I mean, Microsoft just had their earnings, and their earnings came in, I think, 10.87% above expectations or something like that. So, you see some of these scenarios that we're kind of in earnings week right now. It's April 30th, 2020, running a marathon of videos. So if you've seen kind of like a pattern in the videos, I don't know when they'll get posted, but I'm trying to make as many videos as possible while the sun is shining and I'm feeling in the mood, kind of chunking it out. I find it's more effective, more productive to be, doing a bunch of that at the same time than trying to piece it out, one every few days or something like that. Anyway, okay, so where are we today? Well, what I would say is, by the way, Bitcoin is up 20% or something today, so went from around 7,000 to actually dropped down to like 6,800 or something like that, and is now up to over 9,000. Last I checked, it had hit 9,400 and come down maybe in the last, I don't know, hour or so. It's gone, who knows what it's done. But anyway, it's in that bullish range. So we will see. We'll see what comes of it and whether it continues on. I think that what I wanted to talk about here is really the fundamental investing outlook, not from the perspective of what to invest in, but that I think it's worth having an understanding of what is the game that you're playing, okay? And loosely speaking, I would say that there are 3 games that you can play, okay? The first one is what I would call a passive or semi-passive self-managed investment, okay? This is, you do the Warren Buffett philosophy. So for those of you who aren't familiar, the Warren Buffett approach is, hey, dollar cost average 90% of your wealth into the S&P 500, put the other 10% in cash and get back to work, okay, to build more. And this will probably do relatively well, all right? Okay, fair enough. There's other alternatives on that, like you could have kind of the Ray Dalio model. One of the things that I'm advocating to people quite a bit now is I'm saying, hey, look, usually if you do an analysis of broad asset class-based investing over a long period of time, putting a piece of gold in there and rebalancing is generally going to enhance the overall performance of the portfolio. So I would say, hey, look, instead of 10% in cash, put 5% in cash and 5% in gold, as an example, right? And I've been advocating that, I think generally speaking at this stage, physical gold is better than paper gold. You certainly can actually sometimes sell it for above spot price right now, which is interesting. And there's all sorts of reasons for that. Jeffrey Gundlach, who is probably one of the top investors that is worth following. He is known as the Bond King. He runs like a $150 billion fund. Very sharp guy. I really like Jeffrey's insights quite a lot. His argument is that physical gold is good for the exact opposite reason that oil went negative. So just a little while ago, WTI, the futures contract for May hit negative $35 a barrel, closed at negative $35 a barrel, and then it quickly recovered, etc. But Western Canadian Select also went negative, etc. So anyway, like why that can happen is very similar to, in reverse, why you would want to have physical gold as opposed to paper gold, okay? And realistically, because if you have physical gold, you can make different arguments. I'm a fairly big fan of, you're gonna have a small amount of it. It's probably not a huge amount of money, depending on how much wealth you have. If you've got hundreds of millions, then maybe a little bit different scenario. But if you're in a situation where you're saying, hey, look, I'm a small-time investor, maybe I'm putting, $50,000 into gold or something, well then you can afford to store it on your own. You don't really need it. I wouldn't particularly pay, because this is one of the problems with it, is you pay, in some cases, say 3% a year to store it. That's a horrible scenario as far as I'm concerned. So I would be inclined to say, okay, I'm gonna store it myself. I'm gonna have it in a safe deposit box somewhere. I'm gonna, have my own little vault aside, and that's that. So anyway, that's, an argument. So anyway, the bottom line is, if your game is, hey, I'm picking some long-term assets and I'm just going to hold them over time and I'm not going to be actively trading them, then the way that you can do that is you can say, this is one way of doing it, right? The Ray Dalio way includes some bonds in there. There's a lot of different combinations of bonds and stocks. Right now, in my opinion, if you're doing that long-term hold, I would never buy bonds right now. I think it's a horrible government bonds or low-interest corporate bonds. To me, if you're not actively trading them, the coupon rate that you're getting is super low. The upside in this environment is very poor because interest rates aren't going to fall a bunch, but they can go up a bunch, so that's very bad. I wouldn't go with that. So I would say you could do some private debt. I think private debt can be a great way to go. Like if I was playing that game, that was the game that I wanted to play, I would take, probably 5 to 10% of my money and I would have it in gold, right? I would have, 5 to 10% and have it in cash. I would, of course you would pay off your consumer debt and a bunch of these things. I would probably own my own property. I would own some real estate for sure. And I would do that selectively, and I would make sure that I have high cash flow, and I would have it leveraged, but not too leveraged. I would know that I could have it well managed, etc., things like this. I would have some high interest debt. So high interest debt, I'm talking in excess of 10%, but then what you have to do is you have to really be good at making sure that it's safe debt, right? So it's, backed by some real solid security, you understand what the mechanism where it's going in is, and so, you can probably do somewhere between 10 and 20% a year in terms of return off that debt, okay? But again, each of these has their own different criteria to them, right? Understanding how it is that they work. And then I would have, a portion in stocks, right? And for stocks, maybe you would do the S&P 500, maybe you would mix a little bit with some sort of emerging markets, something like that. The argument that Ed Bogle, who's the founder of Vanguard, makes is, hey, look, if you're buying the S&P 500, you're exposed to the global market anyway, because all those big companies are typically dealing internationally. So, you're getting that kind of exposure, which is, a fair argument. That would probably be what I would do. And then depending on, what stage I was at in life, I would tier out what percentage needed to be liquid, at what point in time. I would look at, am I more dividends focused or less dividends or more growth focused, etc., and go there. Now, in my opinion, over the next while, I think that the place, you're probably going to have a lot of money flowing from the central banks into the system. I mean, not probably, we are, right? That is happening. So if you look at what quantitative easing did, quantitative easing made it arguably much harder to find alpha because it caused the assets to correlate much more strongly, right? It just kind of flooded. That probably combined with passive index investing was an effect on that. But anyway, if you had those and then you rebalanced annually, you dollar cost averaged into that and you rebalanced annually, that would probably be the way that I would play it if I was going through that game. It's not the game that I like to play because I want to try and beat the market. I think it's fun, but that would be what I would do. Now, and so, you'll notice that in that scenario, you're not too overly exposed. Now, if you're saying, hey, Michael, what about right now? Well, let me give you kind of the right now. The right now is real estate typically lags the stock market. The stock market has taken a downturn, and so real estate potentially could be taking a downturn. Now, you do need to realize that real estate's a fundamentally different asset than stocks. So people will ask, somebody asked me yesterday, they're like, hey, what do you think about the real estate market, kind of coming out of this? It's like, there is no real estate market, okay? There are many real estate markets. So every real estate is a highly local asset. Stocks are not a highly local asset. And so they are fundamentally different. Real estate is a utility asset. Stocks are a speculative asset, right? So there's fundamental differences in terms of how these behave. So whereas I was saying when you're looking at debt, your biggest concern when you're looking at debt is, are you getting your money back? Is your money safe? That is the main thing that I would be thinking about. You're like, I need to pay attention to getting my money back, okay? When I'm talking about real estate, I'm saying, okay, what do I want to pay attention to? I want to look at the quality of the deal. I want to look at the location. I want to look at the management. I want to look at the actual property. Those are like the four things that I'm going to pay attention to. But the quality of the deal makes a big difference. So I was talking to somebody yesterday and having some conversations about one of the markets in the US being able to approach builders right now and get potentially 35% off list price. Okay, that's a big discount. Is it enough? Like, will the market drop enough and stay down long enough that you're not going to get a major return on that? It's possible, right? It's hard to say what's going to happen. Certainly real estate markets have at their peak gone down by over 50%, right? So it is possible. I think it's unlikely that you're going to see like a 50% decline from the current prices in real estate. The nature of what drives real estate prices has a lot to do with supply. Like I said, has a lot to do with utilization and has a lot to do with the size of the debt markets. And so they've done a lot to shore up the debt markets in ways that having a very high default rate across the spectrum is pretty unlikely, okay? So I think it's very reasonable that, especially in certain markets, for example, if you were to look at Las Vegas, will Las Vegas real estate prices probably fall? Probably, right? You've had the Strip shut down. It's never been shut down. You have this whole environment that relies on 42 million tourists a year that's seeing that decimation of that. Even if things open up and people go crazy and they're like, hey, I have been stuck inside for 2 months, so this summer I'm gonna go wild. I just don't see that coming back to the same extent, and it's gonna be a debt-laden environment for the businesses, etc. So in general, I think places like Las Vegas, as well as places affected by oil. So I lived for a time in Edmonton, and like the whole Alberta economy, as far as I'm concerned, very bad situation, very, very bad. I would not buy anything there for more, than like probably 35% below list price today. probably at least. Maybe like that's a market that I could see dropping 40, 50%. And I think a protracted long-term downturn, because oil in Alberta is a really bad situation. Okay, it's not oil in a bunch of places, you know, okay, the oil prices are down, but if you're in Texas or if you're in the Middle East, right, then your situation with oil, it's like, okay, it can recover within a reasonable time period. They can, you know, start having the global demand ramp up. They can exhaust the reserves that have been set in tankers sitting around, etc. And we can get to some sort of a normal median supply-demand relationship. Okay, that can happen. If you're looking at Alberta, you're saying, well, Western Canadian Select is already trading at a discount because of the, the cost of transporting it. It's very expensive to pull out. I think you're gonna have a lot of jobs lost. A lot of people are gonna move away. It's a very bad situation. It was really poorly managed on the part of the government there. They didn't diversify the economy. It's horrible. It's an atrocious situation for not just the current government. The current government's bad, but you know, going back like decades, they should have been planning for this. Anyway, I think if you look at Dubai, it's quite interesting, right? Dubai had a massive oversupply. What does Dubai rely on? Oil and tourism, right? These are like their two arguably major industries. Well, tourism decimated, oil decimated. You know, I think you can see there could be some good buying opportunities in Dubai. I can't say for sure, you know, but that's something to look at. Will it stay down long? You know, I don't think it's going to be a rapid recovery in Dubai. Some places you could have a rapid recovery, right? If you're looking at, I don't know, the Seattle market, right? Maybe you could have a rapid recovery. I haven't studied the Seattle market, so don't quote me on that. But just understanding that location is very important when it comes to real estate. And in real estate, the thing that's so unique compared to, say, stocks is I can negotiate a better deal, right? I can't go and negotiate a better deal on stocks unless we're talking about a private placement, right? So as a result, I can go, okay, well, you know, I'm just not going to take a deal unless they're willing to do something way lower. And if I'm buying from a builder who needs to clear out inventory, that's very good. There's been, in my opinion, a lot of overbuilding in much of the world. I'm a big fan of Kuala Lumpur as a place that's great value. Kuala Lumpur is way overbuilt. Dubai is way overbuilt. A bunch of these places way overbuilt. There's a bunch of excess inventory and more coming online in Manhattan and a bunch of other places. Okay, so in general, I think that is something that is pretty worth understanding when you're paying attention to real estate. So again, protection of your capital. You're not going to lose the money on interest-bearing like loans, bonds, because that's a big. You could have 100% loss there. You're not going to, provided that you have the cash flow to sustain real estate. When I buy real estate, my philosophy is always cash flow. I always want positive cash flow and like a margin of safety on that positive cash flow. People don't, maybe I'll do a video on it at some point now. But the bottom line is be aware that you can negotiate prices down, buy for less than it's worth, buy in a good location, manage it well, etc. And then stocks. But bottom line is I wouldn't buy buying real estate in most cases right now. I would be looking 12, 24 months out because real estate is a slower market to respond. So what we're seeing now is nobody's out doing buying and selling, right? It's just not happening because everybody's locked up. So as that happens, we're going to start to see activity. We're going to start to see what happens in the prices. We're going to see how many businesses have gone under. We're going to see how many people lost their jobs permanently as opposed to just being furloughed for a period of time. We're going to see all the consequences of that. My guess is that by and large, that's going to have a negative effect on a lot of the real estate markets. And so there's going to be some opportunities to buy, but I'd be sitting in cash or gold or something similar during that time. I might get rained on here. Anyway, not so sunny anymore. Okay, stocks, would I be buying? No, generally I'm not buying stocks unless they're stocks that have gone down a lot. So I was mentioning some of them before that, you know, I thought were interesting. Those ones that are beaten down, if they haven't come back, you know, I'm still fine buying those. Okay, I'm monitoring the situation, but buying a general index, I wouldn't be doing that. The one place that might be interesting at this stage, if you're paying attention to it, and this is, you know, kind of getting into one of these other types of investment, is resource-based, what I'm saying, resource-based, like gold mining companies. So if you understand how to analyze gold mining companies and kind of that sector, you can buy like a fund of those or whatever. If the price of gold continues to go up, you know, there's some reason to believe that those may perform better than a lot of the other stuff. You could get in, there's lots of different, you know, you could pick the companies that are probably going to do well. But what I've noticed is most of those haven't taken a big hit. So I'm contrarian, like I'm a counter-cyclical person. And so I believe that, you know, the things that are very beaten down, that's where I'm interested in looking. So if you're going to kind of pay attention in that sense. But by and large, right now, I'm not buying stocks. I think that stocks, the general market average as a whole is not doing well. Okay, by not doing well, I mean it's expensive. It's gone up way too high given the prospects and current outlook, etc. It's going to be weighed down. As far as I'm concerned, the only reason that it's up where it is because it's a massively manipulated market. Central banks have stimulated it to this ridiculous extent that is totally irrational. So anyway, that's a perspective. Could be wrong. It's entirely possible that you see new highs, but I think that there's a reason to believe that it's going to drop again. And so being a little bit heavier in gold, I think there's some reason to say that gold will continue to have a bit more of an upward trend, and so on and so forth. So anyway, second philosophy that you can take to investing. So the first was kind of a more passive investing, and I got a little more in detail there than maybe I should have on some of the specifics, but if you were just engaged, that's what I would say, right? Diversify between some of these broad asset classes and play out your game over time. And rebalancing. Okay, so the second one is a really interesting one that is quite, actually I'm going to skip from the second, I'm going to go to the third. So the third is your active investor. So a lot of what I just gave you were kind of active investor type thoughts, right? If you're an active investor, the name of your game is to play fairly short term, okay? Because you're believing that you can pick timing better than just holding, right? That is the main reason. Okay, maybe you're trying to do a Buffett-esque thing. Very, very tough to do. To pick something that you're going to buy today and you're going to hold for 20 years and pick a really precise individual asset. You can do it. It's not to say it's impossible, but very difficult to do. So by and large, more what you're going to do is you're going to make your money off buying and selling in and out. And if you're an active day trader or a swing trader, you can do much, much better returns than the market. But you need to understand that game, which is fundamentally different. It departs, you're much more concerned about technicals, much less concerned about fundamentals, even less concerned about underlying economics. So things that might do very poorly in, even the near future, you can do well. So it's a lot about execution, right? You can be wrong and still make money, and you can be right and still lose money if your technical execution is bad. Okay, so that's a very interesting game. I think that there's tons of opportunities to do very well in it. And I have some close friends who do great, and for somebody who's willing to put their time in, fantastic. I think in order to be able to do that, though, you need to be able to spend the time, and you need to have a sufficient capital base. It's hard to do this and kind of compensate for what you're losing out in earned income if you're in a situation where you don't have enough capital. Okay, so and by the way, you could do that you could actively invest in properties and flip them. You could do renovations and fix them up and all this kind of stuff. You do all that kind of stuff. Eventually you can manage money, and then you could leverage up further, and so on and so forth. So that's interesting. This brings us to the third, and the third is probably the best for people who are willing to spend a tremendous amount of time building relationships and finding opportunities, but not willing to put in the extreme time that takes for active investing. And that is, you find, I would say 1 to 3, probably tops, maybe 4 max, great money managers. And so instead of investing in, say, indexes, instead of trying to pick the best stock, you pick them and you stick your money with them. I think that is increasingly a philosophy that resonates with me. They will charge you fees, right? Maybe it costs you 20% of what your profits are or something like that. But it's worth it if they're good. Now, I'm going to point out, by this I do not mean mainstream Wall Street money managers. Most of those are fucking morons. They don't know shit. They do very poorly. They don't beat the market, okay? So I don't think that that's where you gain your edge. They're, okay, so if you can find, George Soros, if you can find Stanley Druckenmiller, if you can find, people like that, okay, great. But the chances are, those guys are already in it. If you could have got Jim Simons, people like this, okay, they're mainstream now. But you're more looking, I think, for some of the up-and-comers. And I see this a lot with real estate, right? I see friends of mine who, they do really well at investing in real estate. So you can basically give the money to them. They'll take care of all that stuff for you. Yeah, you won't make quite as much as if you did it yourself, but you also don't put all the time in. And you can earn above market rates of return. So a friend of mine, his funds have typically got about 22% a year, right? Over quite a decent period of time. Very good return, right? 22% a year compounded, with low volatility, very stable. He's a very conservative investor. Fantastic. Very happy about that. lots of examples of people who do quite well consistently, beating the market performance with less volatility. Okay, so I think that is, for a lot of people, a great way to go. It's yeah, and so these are kind of these three philosophies, and I think you should understand what these three philosophies are. There's another one that I was looking at, some friends of mine right now. They have an arbitrage fund, and they've just opened it up to investors for a small amount, and they've done very, very well, and there's a good chance they're going to do quite well with extremely low volatility, like just insanely low risk, but yet very, very good performance. So, you know, finding those, it requires networking. Like, if you're not networking, you're not just going to go into the newspaper and find these people. And you probably don't want to just jump on these people, you know, when you first meet them. Like, you want to have some exposure to them to get to know their investment philosophy, to see that they're consistently, you know, engaging in something and have insights that the market doesn't, and they're adaptive. If they're not adaptive, forget it, right? Forget it, because the market changes. So, you know, this is why, if you study, typically the top performing funds for the last 3 years are not the top performing funds the next 3 years. It's just the way that it goes. You have kind of this mean reversion effect. And what's going on there? Well, typically they have a strategy that worked in a particular market environment that didn't work in another market environment. So you need people who have some sort of an edge, and you're getting their edge. You're giving them a bit for it. And that's a great philosophy. So I would keep in mind those things. And for most people, I'd say that third strategy is the way to go. If you're doing the active management, cool, like, it's a super fun thing. You can do really, really great returns if you get good at it, but it's a lot of work. It takes a lot of time. It, you know, is probably the hardest game on earth, one of them certainly. And then you've got the basic, okay, I'm going to put my money into these fixed assets. And so anyway, I hope that's helpful as an insight on how to maximize your returns in this environment, but not just this environment, any environment, and do it in such a way that you're not, you know, wasting your time, etc. Obviously, you can get into other stuff like startup investing, etc., and that's, you know, a whole other game. But for most people, the majority of their wealth probably shouldn't be exposed to that kind of risk. Anyway, if you liked this video, if you found insights, please reach out to me. Share with me your comments. Put them in the comments section. Subscribe to the video. Like the video. It helps us a lot if you share it with people. If you like it, if you comment. You know, I don't know exactly how YouTube's algorithm works, but, you know, we're trying to build some following, so would love if you have any sort of support that you can offer us in that respect. If you'd want some advice, reach out. You can book a consultation, or, you know, ask us whatever. You can go to offshorecapitalist.com, offshorecitizen.net. I have an account on Clarity. You can go and check out the reviews there and things like that. Book a call with us. And yeah, I really wish you guys all the best, and I will look forward to seeing you on the next video.